Hello, everybody. Thanks for attending. Thanks for coming. We're doing this webinar, Smart Growth in the Federal Market, How to Thrive in the Mid-Tier or Stay Small. I know this is a topic that a lot of people have interest in as they grow. We've dealt with a lot of our clients over the years who have had this conundrum of what do I do and how do I do it? There's been some rule changes in 2020, earlier 2020, there were some rule changes that impact some of this. So I kind of want to walk through it and hopefully we can help people down their path. My name is Cy Alba. I'm a partner at the law firm PilieroMazza. I'm in our government contracts group. I've been with PilieroMazza for about 14 years. I've been helping small to mid-sized federal contractors in private practice for, I don't know, 16 years. Before that, I did some stints at State Department and other things. So I've been involved in federal contracting for a while now and got a lot of people through some of this. So this is just about PilieroMazza, about our firm. We sort of a core, we started in the government contracts practice, but we've expanded over the years. And we have a very strong M&A practice, which I'm also closely involved with. And that's some of what we're going to go through today. Our litigation practice, which hopefully no one ever has to deal with. Our labor and employment practice, and also our general corporate practice as well. So getting into things though, what is the mid-tier? We're going to talk about that. There's different explanations, and I kind of want to get that out of the way, and then go through some of the risks and challenges that companies face when they're entering into the mid-tier, and why, as you're growing, you might want to think about things early, maybe even right out of the gate when you first start your company, how you can do things to plan for the future. Because if you start thinking about things at the last minute when you're about to become a large business or you're going to lose your small business status, a lot of times it's too late, especially given some of the rule changes we'll walk through here. And you sort of need to make that choice as to whether you're going to grow and you're going to be a mid-tier company and you're going to do it proudly and strongly or as best you can, or you're going to try to stay small. And making that choice later, like I said, is a difficult one. So first, what exactly is the mid-tier? Well, the private sector, the commercial sector, has definitely a lot of different definitions of mid-tier, middle market, all of that. You'll hear a bunch of different terms: lower middle market, upper middle market, whatever. What you're really talking about there is a bunch of different things: 10 million to 1 billion in revenues, 5 million to 30 million in revenues, 500 employees, 50 employees. It's sort of all over the map, depending on the industry and depending on the purpose. A lot of times you hear this stuff come up whenever you're dealing with M&A companies or M&A advisors and those sorts of things. But none of that is important to federal contractors. In the federal market, you're either small or you're large. And once you exceed the 5-year look back threshold for being a small business in your NAICS code, the size standard that's applicable to your NAICS code, you are no longer a small business anymore. Even if you're over by a couple dollars, the way the rules are set up, you are now a large business. Let's say, it's by example, you have a $16.5 million size standard. You are, say, January 1st, 2021 rather, you're going to look back and you look at your revenues and you're at $16,502,000. You are a large business now for the entirety of 2021 unless you shrink back down. And if you're competing in those sorts of NAICS codes with, say, a GDIT or some other massive company that has billions and billions and billions, hundreds of billions in revenue and $1 trillion market cap, that doesn't matter. For purposes of government contracting procurements, your business that's $2 over the size standard is seen as no different from the largest company you can think of. And so therefore, there's no formal mid-tier program. There's no benefits to being a mid-tier company. It's either small or large. And that's not, though, some people have a misconception that it's whatever your primary code is. That's true if you're an 8A or you got hub zone certification or now WSB, or if you're in CVE and you have an SDVOSB certification. But it doesn't necessarily matter. Your primary code doesn't necessarily matter as to whether you're small for particular contracts. Every contract has its own NAICS code, and that's what dictates the size standard assigned to that code by SBA dictates whether or not you're small or large for that procurement. So just remember that. And again, once you outgrow the size standard, you're just a large business. Some of these codes are very small. I mean, some of you guys might have small codes out there. There used to be, I think, a $4 million code. I believe it's increased a bit now, it might be $5 million now. But if you're in one of those codes that have a $5 million size standard and you're at, again, $5 million and $1, again, you are no different than Boeing, GDIT, or whatever. Doesn't matter that you're in a tiny code or in a large code. If you're going after that type of work and your 5-year look back is too large, you're a large business. There have been many attempts, though, to create a mid-tier program. Unfortunately, they've all sort of fallen flat. I just don't think Congress has the sort of drive to create this kind of program, or you have a situation with the large guys really see more and more of their pie being eaten up. So then I guess, well, what are the risks to becoming an other than small business, to getting into the mid-tier, and why? You probably heard things. I've done other presentations called the walking in the valley of the shadow of death, meaning a lot of companies that go into this mid-tier fall off a cliff, or they lose all their business, or they can't compete and they have to shut their doors, or they fluctuate wildly, become very small again and struggle to survive. And so why is that? Well, the 809 panel put together a very good, what I thought was a very good explanation of some of the issues. And they said, quote, set-asides and other small business programs incent small businesses to make extraordinary efforts to remain small. Setting aside all procurements under a certain dollar threshold does not encourage a small business to grow beyond that threshold, especially if the business relies upon competing for procurements that are currently set aside for small businesses, as outgrowing the size standard makes those businesses ineligible to compete for the same contracts that, in many cases, were critical to the success of the business. And that's exactly the core of the problem, is that you know how to compete in your particular market. And your market, as a small business federal contractor, isn't just government contracts. Sure, you know a lot about government contracts, but the market is small business set-aside contracts, which just by their nature have reduced competition, higher profit margins, and generally are easier to get into. Not that it's easy. Nobody said it was easy, but it's easier than competing with the Boeings and the GDITs and the Lockheed and the Accentures of the world. What's important to note, though, is the 809 panel, I think just as history, the 809 panel actually almost recommended just getting rid of the small business programs entirely. So don't waste time with it. Because of this, their sort of assessment of the situation was the whole program is a waste of time, which I and I'm sure all of you disagree with that. Otherwise, you'd have a mass consolidation in the market, and many, many, many companies would cease to exist. It would create a massive problem, unemployment and otherwise. So the main purpose here, as they noted in the 809 panel, is an inability to recompete for incumbent work, right? Because all work, if there are 2 or more small businesses that are capable of performing it at a fair and reasonable price, has to be set aside for small companies. So because it has to be set aside, if there are 2 businesses, now that you're large, so you outgrew it by $2, you're not eligible to recompete for your same work the next time it comes around. So the question is, are there 2 other companies that can do it that are small and do qualify? If the answer is yes, that work that you have maybe performed for 20 years is going to go to someone else. And so that's a critical issue. Also, if you're an 8A company, 8A work has to stay in the 8A program, what they call the once 8A, always 8A. Now, there are ways to remove it, but it's difficult. So that's another burden that you have to overcome. Also, agencies have small business goals. They have to hit, or they're supposed to try to hit their small business goals, which are, depending on the agency, can be anywhere from 80% to 0 or a couple percentage points. But if you're in one of those agencies where you look at the goals, and it's 23% government-wide, but each agency makes their own. So you might be one of those agencies that has a 60, 70% goal. And that's something you got to pay attention to, because if you're in that and you are sized out, your relationships with that agency might not be worth much anymore for you as a prime contractor, at least. We'll get into other things later. Also, they're moving to these best-in-class vehicles, category management, right? Everything's pushing into smaller and smaller places. So if you are unlucky enough, let's say you sized out in 2020, and let's say proposals were due for STARS 3 a couple months ago. Let's say proposals go out and they're due for CIOSP 4 on, I don't know, December 30th. And you size out, you got to get those bids in, because if you miss it, you're done. And if CIOSP 4, which let's say you've been chasing that for years, gets pushed out to January 1st, and you don't submit your bid before January 1st, you're now a large business. And that whole contract you're going to be out of, probably for the full period. Lastly, SBA changed the rules from 3-year look back to average revenues to determine your size to 5 years. Now, until 2022, you're allowed to continue to use the 5-year rule, right? Or that's whenever this changes. The 3-year rule, instead of, you can pick 3 or 5. Whereas after 2022, you're going to be stuck with 5 years. So once 2022 is over, boom, you got to use the 5-year rule. That's great to stay small for longer, but it's bad because once you trip over that, you now have 5 years of trailing revenues got to fall off your books instead of just 3 to stay small. And if you kept getting bigger and bigger and bigger every year, you might have to wait 3 or 4 years before you're going to actually be small again. Whereas under the new rule, you might only have to wait 1 or 2 years. The other thing is recertification impacts existing work. So recertification is required after 5 years or right before the end of the 5th year on long-term contracts that are more than 5 years. And if you are large at the time of recertification, no new orders can be placed under that IDIQ, and a lot of procurements have off-ramps, like Oasis, for instance. If you recertify because of an acquisition, you're off-ramped. If you're recertified just because you grew, you move over into the full and open, and you have to go fight for work over there. And so you have to pay attention to, well, what happens to me on the work that I have? Also, if you're in a joint venture, if any member of the JV has to recertify as a large business, your entire JV is no longer eligible for the existing work, new orders on IDIQ contracts. Or if you recertify and you have current contracts, you can keep that work for until the end of whatever the period is, the next set of including options. You can keep it the whole time, but the government cannot take credit for it. The other issue is sometimes, let's say a contracting officer doesn't really understand the rules, or for some reason they don't like the work you're doing. They can request recertification at any time on new task orders under an IDIQ contract. So if they come out and they say, hey, from now on, every task order I put out, I want you to recertify. You have to then recertify as to your size as it relates to that task order, at least on IDIQs. And if you're large, then you can't do that. Sometimes contracting officers think that they're doing that because they want to get legitimate small businesses, but that's not the rule. The general rule is you're small for the life of the contract until you have to recertify at that 5-year period. But if it's a 1+4, you're small for the whole thing as long as you were small for the beginning, unless the contracting officer asks for recertification. So it's sort of a way it can be a way that really harms you, even though there's no real reason for them to do it. Contracting officer to actually ask for reconsideration, they get no benefit out of it. I think it's mainly misconception, or they're, again, like I said here, they're just using it to steer work to favored companies. If the company they really like, they know is small, and the couple competitors are large, they think would have a better chance of winning the work, they can say, oh, I'm asking everyone to recertify on this. And there's really no way to protest that because it's 100% in the discretion of the contracting officer. And so they have the ability to steer that work in that way. I mean, if you can prove that they were doing it in bad faith, you might have a claim, but that's very difficult. It's very difficult to make a claim like that of bad faith in certain issues. Next is this issue of no exit. So another risk that comes up is people look at themselves And they say, okay, well, I'm about to be a large business. I don't know if I can run this business like that. I'm just going to sell. But you're at the point where, let's say it's June, and you know you're going to be a large business on January 1st. And June is being generous. A lot of people don't realize this till October, and then they freak out. They look at this and they say, all right, I'm just going to sell my company. Well, if you sell your company, that also triggers recertification. Or if you sell contracts, that triggers recertification to the buyer to recertify just on the contracts that they bought. And so what's important there is if you sell just like 1 or 2 contracts to a buyer and they are small themselves, they can recertify and take those couple of contracts. But if you sell all of your stock to someone, they're going to have to recertify on all the work they bought from you and all of their current work, not based upon their size before the acquisition, but based upon their size after the acquisition. So that even if they merge the 2 companies together or they keep them separate, they're going to be affiliated in most cases. And if they're affiliated, you then have to recertify for both companies based on your combined size. So if you were really, really close to the average already, if a buyer understands the rules, they're not going to want to buy you, because as soon as they buy you, they don't just blow the size standard on your work. They blow their own size standard, and they're stuck in the same boat you were, but now they owe you a bunch of money, or they just spent a bunch of money. So that's a real issue for being able to exit and sell. The other thing here is that if you decide you want to stay and grow as a mid-sized company, and you're going to do a bunch of acquisitions because you need to grow fast, right? If you buy contracts, you recertify, like I said, per each contract that you buy. But if you buy the stock of a company, and I should say this applies to what I said earlier too, it's stock or all or substantially all the assets. If you buy either of those 2 things, you then recertify not on what you bought, but or both on what you bought and what you have currently. So then you have to recertify on both. That will blow the size standard. And if you bought IDIQs or you had IDIQs that have off ramps, you might lose those contracts. And that's even if they don't have off ramps, because of the SBA's new rule, if you recertify, you're also going to have the issue that you will no longer be eligible for new orders under IDIQ contracts after the point of recertification, which has to occur 30 days after a merger or acquisition. So you don't have a lot of wiggle room there. So that's where I was saying it also prohibits the easy sale of stock or assets, because let's say you're an 8A company, any contract that you sell is going to be terminated for convenience unless you get a waiver from SBA. And if you sell the entire business, you need SBA's approval if you're still in the 8A program. So even if you have legacy 8A work and you're graduated, you also need to submit a waiver to SBA, and they're going to analyze it and approve it. And if they don't, those 8A contracts are supposed to be terminated. So if you're 8A, that restricts you further. Small business IDIQs, like I said, they can become worthless because you no longer can bid on task orders any longer. And then another new rule is that outstanding proposals or bids are invalidated if an acquisition occurs within 180 days of when you submitted the proposal. You have to then tell the government, I'm not eligible for this work. You can't award this to me anymore. If the merger acquisition occurs 180 days or more than 180 days after the submission of a proposal, you can continue to perform that work, but the agency can't take small business credit for you anymore. And again, that's the thing. If you get an award and now you have to recertify, you risk getting removed from the contract and all the stuff we just talked about. Also, SBA changed the rules also in early 2020 to say you can no longer hive off assets and use those sales to reduce your size. It used to be that if you sold off a cognizable business unit, what they call a cognizable business unit, if it was a division and it had all of its own people and you showed you really kept it separate, you tracked the finances separately, and it was almost like a little company running inside your company. If you sold that and you could calculate the full 3 or 5 year of revenues going backwards, you could then hive that revenue off retroactively and reduce your average by taking those revenues away in each of the prior 3 or 5 years. Now, however, because the SBA rule change, you can no longer do that. The only way you can hive off those revenues under the former affiliate rule is if you sell a separate legal entity. It can no longer be a division. So that means even if you move assets down into a subsidiary and then sell it, most likely, and this is not clear under the rule, but most likely, you're only going to be able to back the revenues off of your books to the point where you moved it and you created that affiliate. So you can't decide in June, I need to sell my company before January, create the subsidiary, move everything down into July, and sell in October or whatever, and think you're backing out revenues going back 5 years or 3 years. The only revenues you're backing off your books are from July to October, because that's the only time period that that entity was actually created. So just be aware of that. The other thing here, though, is if you're an 8A, an SDVOSB, a WOSB, or an EDWOSB, SBA rules restrict the way you can structure your company because it disallows indirect ownership. So if you want to create a subsidiary of your 8A, you can do that as long as it's wholly owned. But you can't have that subsidiary bid on 8A work or move 8A work into it because that subsidiary is not an 8A eligible company. Same is true for SDVOSB, WSB, and EDWSB. An entity that is owned by another entity, even if that other entity is 100% owned by you as a qualifying person, and even if the entity that wholly owns this subsidiary we're talking about qualifies under one of these designations, the subsidiary does not qualify. And so you cannot move set-aside work down into those companies because when you move it, you need to novate it, you got to recertify, and that creates problems. You could try to do a change of name agreement in certain circumstances, which it's sort of a gray area in the rule. You could try to get away without recertifying, but it can be tricky. Also, you can't have a bunch of other companies as an SDVOSB or WOSB, but you can have some. As an 8A, you really can't. But as an SDVOSB or WOSB, you could set up sister companies. So you own 100% of one, you own 100% of another one. That can work if they're in similar lines of business. And if you say, well, all the work I'm really doing for the one, the hours I'm spending for marketing and back office and everything really helps both. If you get to 3, maybe, but past that, you can't do it. But you can split a couple of them. And then what you could do is split the work up. And then if you need to sell one of them down the line, that will allow you to back out the revenues. So it's not guaranteed, but it's a potential option. And lastly, I think the biggest risk that everybody probably knows about is that bidding and winning large business work is hard, or unrestricted work, because the big guys, their prices are lower, there's a lot more competition, and the way the big guys survive a lot of times is either massive projects that you probably can't perform, or massive DoD, like the F-35 and things of that nature that you just can't. You're not going to build the next, the 7th generation fighter jet or something. You can't do that. All the rest of their work is high volume, low margin. A lot of it, low margin compared to probably what you're used to, and that's hard to go after. Or like I said, it's highly specialized work. And so what happens is not only do you have to compete, it's what I call the double whammy. Not only do you have to compete with the large businesses, but the areas of work that you can go after and you're even capable of performing is smaller because most of that work is all going to small businesses because of the rule of 2. So what are some of our options here? So option 1, which is probably the most common that I see all the time, is stay small. people want to stay small. Well, how do you do that? First, you got to plan now. You got to understand the rules, at least as they exist right now, and understand the former affiliate rule that we kind of walked through a little bit, that a company can only eliminate revenues retroactively if it divests itself of a separate legal entity. Again, it cannot be a division or part of your own company and have it qualify as a former affiliate. This means that if you sell something that's a division of yourself, again, you cannot back out the revenue attributable to that division going back into the past. However, if you were able to, like I talked about before, if you're an STVOSB and you create a sister company, or if you create a wholly owned subsidiary and you have small business work, you can move that work down. And then what you can do after you move the work down to the subsidiary is just let it sit there. You're going to be affiliated with that subsidiary and you're going to have to calculate it into your revenues, right? But it allows you to sell that subsidiary when the time is right. And then all the revenues attributable to that subsidiary from the time you started pushing the work down or doing work all the way through until the date you sell it, it all comes off your books. So strategically think about, well, what work can I put in a subsidiary? And how can I structure my business to take advantage of, let's say I'm 8A, take advantage of 8A, but for all the small business work I'm going after, I'll create a subsidiary or multiple subsidiaries that are all 100% owned by my 8A, which is allowed under the rules. And I'm going to move certain small business work into subsidiary A and certain into subsidiary B, and I'm going to call it the 8A group or whatever the name of my company is. And I'm going to have all these different companies underneath my 1/8A to move all this work around. So then let's say something becomes less profitable, you sell it off, or you dissolve the company, you get rid of it, and then all those revenues go away, all the way back 5 years. Another thing to note is that this work I'm talking about moving down, in theory, it's either full and open work, vanilla small business work, which means no set aside, just small business set aside, or also hub zone now. SBA in 2019, I think, allowed hub zone firms to be held indirectly instead of directly by a human being, like the rules are for 8A, STVOSB, and WSB. So that means the hub zone company can be independently certified even if it's a wholly owned subsidiary of one of the other types of businesses. So again, if you're an 8A company, you have a wholly owned subsidiary, your 8A company might not qualify for hub zone, but your subsidiary might, depending on how it's structured. I can't really get into the details, but there's ways you can structure a hub zone subsidiary so that you only look at the subsidiary's employees and whatnot to qualify for hub zone. And then if something happens, you can sell off the 8A, or let's say you graduate from 8A, you can sell off the parent, or you can sell off the subsidiary, or you can close up the subsidiary if it's not doing well, or whatever. And the revenues attributable to whichever company goes away is removed from your books. So again, think about the flexibility that you can take and how you're planning. Also, I sort of alluded to this, but the restructuring rules, because you have to recertify, even if you're moving things around, if you're moving contracts around and you have to perform a novation, even if it's within the same group or family of companies, if you have to do a novation, that's going to trigger recertification. And so if you're large and you're just moving things around, that can make you ineligible for the work that you move. And you don't want that. But there's something called the by operation of law exception to novation that allows you to use a change of name agreement. And I said here, it's not guaranteed to work because I haven't seen an SBA ruling on it. But there's a good argument under the rules that if you do a change of name agreement and not a novation, then it's not a merger, it's not an acquisition, and it's not a novation, and therefore it wouldn't trigger recertification. Another piece is understanding the JV rules. So if you perform a lot of work through a joint venture, you only take the revenues onto your books commensurate with the work you performed for the joint venture, not 100% of the revenues. So if the JV is doing 50% of the work and you're the 8A or you're the STVOSB, and you have to do 40% of that 50%, and the other 50% is subcontracted out, you, by doing 40%, which is the minimum of whatever amount the JV is doing, so in this example, it's 40% of the 50% or 20%, you have to look at that as I'm doing 40% of the work, and therefore I have to take on 40% of the revenues on my books. The other 60% goes to your JV partner. Whereas had you done it as a prime sub, 100% of that work would have hit your books. So that's where it's very important, because the only work that you put on your books is the work that you do. And if you attach a similarly situated company and bring them into the joint venture as well, you can split that 40% with another 8A or with another SDVOSB. So let's say you have 100% of the contract, you're subcontracting 50% out to Lockheed. You have to do 15% in the JV. Out of that 50%, you need to do 40% or 20%. Well, that 20% of the total work can be split 10% with you. If you, let's say this is an 8A set aside, 10% with you and 10% with another 8A, so long as they're a member of the joint venture. And then the other 30% inside the JV can be performed by just a vanilla small business. And then the other 50 is by whoever outside of the JV. And if you do that, then you're only doing 20% of the entire contract. And so therefore you only take 20% of those revenues onto your books, while you get to take advantage of the past performance and the experience for the entire contract in most cases. And so that's also an important note. And if you do JVs early in your life, the way that we just talked about it, you might give yourself years more runway, because most of the time, if you're a prime contractor, if you're subcontracting any of that work out, you're not getting the profits. You're getting no benefit, but you're taking all those revenues onto your books. I mean, yeah, you're the prime and you get to take prime contractor past performance and everything else. But in a lot of cases, if you do it inside a JV, you could do the same thing. Not guaranteed, but a lot of times. So it's really beneficial to do things in a JV. Another thing is sort of, can you shift your business? You're looking out there and you're saying, this is the work I'm doing. Well, look at USA Spending or SAM or other places and see, well, what codes out there does the government use to buy the goods and services? And if you're a new company, try to see if you can fit into one of the NAICS codes and do work under NAICS codes that have a bigger runway. Is there one out there that's your new company at 16.5 million? What about 41 million? Even better, something like that. Try to see if there's codes that you can use for those areas. If you're a mature company, what about a shift? If let's say you're in a size standard that's 16.5 million, that's for consulting services, but you do a lot of IT consulting. Well, maybe some of the work you do could really be fit under one of the other codes. Or there's work that you could possibly bid for and pivot your company to be less of a consulting firm and more of an IT company. Then you got from 16.5 million to 41 million runway. So you can continue to grow. Another piece with NAICS codes is, let's say you look at the work you're doing, sort of audit the work that you have and really dig into it. Dig into the definitions of the NAICS codes, dig into online with the Department of Commerce and dig into the requirements of the contracts and compare them. Is it possible that, to use this example again, is it possible that maybe the consulting work you are doing really isn't consulting work? It's really IT work. And so it shouldn't be 16.5 million. All these work you've ever done was under the wrong NAICS code. It should have been under a $14 million size standard. In that case, you could actually, when you market yourself and market the work, if the COs love you, you could tell them, you put the wrong code on this. You should put the bigger code. And then you're eligible. You're going to open up the market, have a little bit more competition, but not as much as full and open. And so that really helps you as well. Also, if they don't listen to you and you think you've got an argument, you can file an appeal with the SBA's Office of Hearings and Appeals, challenging the NAICS code and demanding that the higher code be placed on the business, on the contract rather. Again, the other thing is restructuring your company. Like I said earlier, you could put subsidiaries in place and move work around. Again, for HubZone and vanilla small businesses, you can almost split it up any way you want if those are your only two designations, because you can have indirect ownership. You can create a holdco and you can create 20 different subsidiaries under it. And every subsidiary takes their own piece of the work. And in most procurements, because you're all affiliated, You can all use the past performance of each other, but you have to have some sort of material involvement in the work. So that's where it gets a little tricky, and that's sort of outside the scope of what we're talking about, but it's not prohibited to use past performance of affiliates in most cases. So restructuring your company doesn't necessarily harm you. For 8As, if you're an 8A company, you can still create subsidiaries that are 100% owned, so long as the work you're pushing down and this has HubZone and or vanilla small business. And if you're pushing down HubZone, you got to get that subsidiary HubZone certified independently, but it's possible. Again, with SDVOSBs and WSBs, you just create sister companies instead of subsidiaries. And you can actually have the sister companies qualify potentially, I said maybe 2, maybe 3 if you're really lucky, as the same designation as your one company. The other benefit there is actually if you sell a sister company as opposed to an affiliate, the purchase price payments go to you, not the company. Whereas if you sell a subsidiary, the purchase price goes to the subsidiary and then is distributed up to you so it can hit the company's books. Whereas if you do it in this way where they're just sister companies, you don't have to worry about that. Another thing just to think about is that if you're an S corporation, it can be or if you're an LLC that's done an S election for tax purposes, or you're a corporation that's done an S election, therefore being an S corp, it can be very difficult to divest because acquisitions by major investors, they don't acquire themselves as a human being. They use entities to do the acquisition. And if an entity, an LLC or another S corp or a corp, if those companies buy into an S corporation, buys a stock, it's often treated as a divestiture of assets and there's major tax implications. And a lot of times I see companies don't realize this until they want to sell. And then we sit there and look at them like, oh God, you're an S corp. You're going to have to do an F reorg where we're going to have to put in a holding company and do all these machinations to avoid major tax problems. But you can't put a holding company in if you're an 8A because you have to be directly owned by the 8A member. And then you're going to have to do a waiver and SBA might reject the waiver. Or if you're FCVOSB, you have to be directly owned. You can't put the hold co. And so it creates issues when you're structuring these deals and it may not work. So I recommend it might cost you a little bit more in your self-employment tax to have an LLC, but if you're going to sell and if you're planning on doing it, it can be a major issue later. Another thing, JV by contract. Some people say, well, I don't want to form an LLC. I just want to do a JV by contract. Well, that can be problematic too. It might be, you might think it's easy or simple. It's really doing an LLC is no more work than doing this. But the problem with doing a general partnership, i.e. JV by contract, is that you form a general partnership. Legally, you're not just two companies. You are a general partnership. So if the JV does something wrong, both entities are jointly and severally liable, and there's no limitation on general partnership liability. So if the government has some beef, your JV partner messed something up royally, you got terminated for default, they bought something from someone else and it cost them 10 times more, that partner then goes bankrupt and goes away, the government can seek 100% remuneration from you. Option 2 now. Well, what if you want to stay and live in the mid-size, as a mid-sized company? Well, you got to figure out, do I want to be a quote-unquote lifestyle company, which can be great. You just make good income. You're not looking to sell. You're just looking to go. Then there's certain things that you might want to do. Whereas if you want to sell your business, you're going to have to focus more intently on growing value. And growing value is more difficult because you got to plan for going after that full and open work. Plan for that 5 or 10 year cycle. Look for emerging technologies. Can you be first to market? There's a lot more sacrifice that's going to have to go into it because instead of chasing the high profit margin small business work, you're going to have to really take that money and invest it in going after unrestricted work, but getting more experienced managers and staff and bring in a CFO and do all these things to continue growing your company, which is going to cost you more money now, but can net you more money later, maybe. And that's the thing. Do you want to put that risk on the line? You're an entrepreneur. You went into this knowing there's risks, but how much risk is your tolerance is the question. So if you want to go and sell, investing in the long term is key, right? So you know how to run a successful small business, but now you got to be able to run and grow a large business with all those risks and problems we talked about. How do you overcome those? Maybe you can do it yourself, but a lot of times you need to recruit key management from larger firms. That's what I've seen other companies do that are very successful. You hire a key management team, you bring them in, you incentivize them with certain, stock options and things of that nature. If there's restrictions because of small business work, you can give them phantom stock, other things like that. But you really bring them in years in advance so that you have runway to plan this graduation, to plan this move into large business. Look for particular procurements that are out there. Look for like a particular contracts in the future that's going to be huge. We're going to focus our resources on that. That's putting all your eggs in maybe one or two baskets, but that's part of the risk. Because if you hit that jackpot, you might be golden, and that's going to put you on course to selling your business. If you miss, though, you might shoot for the moon and crash into the sun or whatever and burn up. That's certainly possible. But without taking some of these risks, you might be jeopardizing your ability to sell for good value in the future. Network with government officials also. Figure out what's out there, what's new, what are they looking for? Go to, and again, this is also about hiring people and taking all the knowledge you can to figure out where to steer the ship and how to do it most effectively. And also, what about commercial sector? If you've been successful and you've been very successful, let's say you're a small business that's barely grabbing onto the $41 million size standard. Let's say you got 80 million in revenue or something. You could take some of that money and push it out into the commercial sector potentially, where your size doesn't matter. Growing by acquisition is another thing people try to do. But like I said before, that's risky because if you acquire another business, merge it together, you're going to have to recertify on all of your legacy work, which might be a bunch of small business work that you might have to recertify as no longer being eligible for. So if you're going to buy something, whether it's stock or assets, you got to plan that carefully for the ways that we talked about. And if you're, again, it's a risk reward. If you're willing to take some of the risk, there might be ways to structure the acquisition in order to avoid recertification, taking advantage of certain interstices in the rules. That's kind of a gray area, but obviously I'm happy to kind of talk through that if people want to discuss. I don't really have time right now. But lastly, and this is very common too, I think everybody probably knows the mentor protege program. You're a large business now, you got a bunch of incumbent work coming up. How do you capture it? You become a mentor, find a protege that's qualified to prime, or you in a joint venture can prime. If you're in a joint venture and you're in a mentor protege, you can actually take 40% ownership in your protege. You can form a joint venture, and if you and your protege are doing all of the work on the contract, that allows you to get 60% of the work on that contract you're doing through the JV, which, again, if the two of you are doing all of it, and your protege is capable of doing 40% of the entire contract, and you can take 60%, plus you have 40% of the protege's sort of revenues because you own the equity, that can give you roughly 78% stake in the business that's flowing through the joint venture. So you're losing 22%-ish. That's not bad. That's not a bad way to continue your lifeline and continue growing. And that's completely allowed by the rules. There might be rules if your protege is in 8A, you can't liquidate all of that other 40% of ownership that you have in the 8A necessarily, but there's a lot you can do there. And if the company succeeds and sell, you also get 40% of the sale price of that company. So there's possibilities there. And remember, you can have as a mentor 3 proteges at any time. So it's hard to have them all in the same industry, but if you want to diversify, you could do this same structure with 3 different proteges, multiple joint ventures, and kind of work this to move as much of your work as possible out of the program. And then lastly, I guess, if you don't want to stay small and you're not going to just really push into the mid-tier, I think the question is, well, look, I really just want out. I want to retire. So should you? Should you exit, or do you have to kind of stick it out? If you want to exit as a small business and you don't have anything to do with the mid-tier market, you got to think about timing, because a small business needs to sell when they're not close to their size standard for the reasons we talked about. If someone buys you and they're a small business and the value in your company is all small business set-asides, but you're close to the size standard, there's probably no one that can buy you, because the second they buy you or substantially all of your assets, they're going to become affiliated with you. And they're going to take all your past revenues onto their books. And if you're at $16 million out of a $16.5 million size standard, and the company that wants to buy you has an average revenue of 1 million, they can't buy you. Forget getting the money, even if someone would loan them the money. If they buy you, they're now a $17 million company. They recertify on all their work and they're no longer a small business. And then they're stuck in the same position you're in right now, but now they're out however many millions of dollars it took for them to buy you. So if they know what they're doing, they're not going to take that deal. And so you need to plan things early, or you sell off contracts piecemeal to different companies, and then they only have to recertify on their own stuff. They don't have to recertify by taking into account all of your revenues. But selling things off piecemeal is never worth the same amount as the whole. It's also of note that you can't sell off a contract and then take all the past performance. GAO has some pretty clear cases that you have to be a successor in interest to do that, which means they basically have to buy all of you or close to it. Also note that novation of what I call naked contracts, an IDIQ vehicle that has no work on it, even if it's like VETS 2 or STARS 3 or CIOSP 4 or whatever. GSA in particular is a stickler for the Anti-Assignment Act. And the Anti-Assignment Act basically says contracts, federal government contracts cannot be bought or sold, prohibited. And the only way you can do it is if the contract is part of a larger asset pool. And in that case, you can push things off, right? You can sell it as part of a total asset sale. But a lot of people want to go buy, oh, this guy's had a VETS 2 for years and it's worth nothing. Or that IDIQ is about to die and I want all the past performance. I'm going to go buy it. It doesn't work that way. So if you think you're going to hive things off and make a lot of money from your contracts and sort of retire, be careful with that. Now, if you're a mid-tier business and you want to exit, again, you got to kind of be in it for the long haul. You got to take the right steps to grow, because you need unrestricted work, as much of it as you possibly can. It's going to take years probably to do that. And if you have a lot of small business work and now you're growing into full and open, all that small business work is going to be at risk if someone buys you, and that's going to reduce the value of your company to something you might not be happy with. I've had clients that are valuable enough that they could take a loan and pay themselves with the loan that's bigger than the purchase price that they could get from a third party. So why do that? Take the loan, throw it in your account, have the company pay it off at some point, and then move forward. Like, there's other things you could try to do, but you got to be in it for the long haul. And if you really, really, really have to retire, you just got to know that it can be difficult, but something like maybe an ESOP. You might be able to sell it. They're very complicated and they're going to be costly for your business going forward, but it's a way to basically sell to yourself. There's a trustee involved in other things, all these ERISA rules, but you could get a better purchase price for yourself through an ESOP than otherwise. And so this is just some of the options that I was thinking about that we could talk through. But if anyone has questions, you can reach me. Here's my email address, phone number, and I'm happy to talk through any questions. So again, thanks everybody for coming today. I appreciate it. And we'll talk to you soon.